Welcome back, everyone. I'm Jordan Giesecke, and this is The Limiting Factor. Today, we have two special guests, Rodney Hooper and Howard Klein of RK Equity. I've been in contact with Rodney and Howard for about 3 months now, and I've been impressed with a lot of the insights they have about the battery materials mining industry. And that's going to be the topic of conversation for today. With that, I'd like to welcome Rodney and Howard. Thanks for joining us, guys.
Thanks for having us, Jordan.
Yeah, good to be here.
All right, so just to give people a bit of context, what does RK Equity do?
RK Equity is just a boutique advisory company. I've been in business for 18 years, and we have helped small, early stage companies, mostly in the natural resource sector, often public listed companies, sometimes private, and listed in Australia or Canada, and also in the United States, but largely companies that are pre-revenue development companies that are seeking capital to advance their projects and then become part of the supply. And we over 20 years, we've done a lot of things in gold and copper and iron ore, et cetera. But in the last about 12 years ago, I started in lithium, including what is now, Lithium America's, Thacker Pass project, and we represented that company for quite some time. But in the last 4 years, we focused really exclusively on lithium battery materials, and I would say 80 to 90% of that is lithium, although we've done some nickel and graphite, and a bit of copper of late. So we are an extremely good filter of what we think are the best projects, certainly within lithium.
Where are we currently for lithium prices and battery materials?
Jordan, let me have a stab at that. So one of the things that you've got to realize with the lithium market is it's a fraction of the size of the nickel market or the copper market. I mean, the entire lithium market last year is probably roughly $3 billion. That's the total. And within that, you already have specialized products where there are specific suppliers and specific customers, and then their contracts as well. So the amount of lithium that actually trades openly in the market is very small. So where are we? Well, we've come from a place where the pricing hasn't been sufficient enough to incentivize incumbent producers or new projects to get into production. And now, with EV sales, hitting, people look at it in different measures, but let's call it 3.2 million last year, and now we're looking at, in our estimate, 5 million this year. Suddenly, you've got a lot of big models, as you'll know. You've got the Saba, the Semi, the Lucid, Rivian. These are big models, high nickel batteries, enormous battery packs. Suddenly now, a market that's been in marginal oversupply is now going to be in undersupply. And you saw prices plummet on a marginal oversupply. Now what will they do in an undersupply? If we're going to move into undersupply, then where are we? We're at the start of a rise in prices to incentivize more production to come on. So Jordan, in terms of demand, we're definitely seeing a demand uplift, and we're likely to see some kind of a price uplift. But the question then is, it's up to each investor to work out what they're prepared to pay.
So the market broadly for a lot of things are expensive, right? QuantumScape, and many other EV SPACs. So money is available. So when Rodney kind of talks about like what kind of yield you're looking for, it is a good time to invest in lithium, but you definitely need to be more selective. We are in a very bullish, euphoric market, and there's a lot of less good projects that suddenly kind of come to market. I had a call today with someone who was just like, "Oh, lithium's hot again, so I'm dusting off this old crappy project, and I'm going to try to put it, into." Try to raise some money on the back of it, or put it into a public company and promote it. So this risk on behavior, it makes it very important to be very careful. So these stocks are prone to commodity-like volatility, and there's investing and there's also trading. So there's a lot of being on the backside of a negative trade. Rodney and I have been, have experience, in this regard. The upstream pre-revenue companies they're still risky. There's a lot of value, but you got to do a lot of work. And if you do your work, you could make those 3, 4, 5 times returns, but you have to do the work.
So the market's run quite a bit, and there may still be some potentially some opportunities out there for stocks that haven't been recognized yet. Is there anything or anybody that you're partnered with that kind of fits that description at the moment? Is there anything that's really asymmetric that's, for instance, a low valuation that in the future has the potential to be a much larger company? So, like a lot of the stocks that we saw, like Piedmont, for instance, 6 or 9 months ago.
So Jordan, this is a scoreboard that I put together. So this is RK Equity. This is our brand. I'm the Lithium Ion Bull. That's my my Twitter handle, and it's also part of the brand. This was taken from January 29th. By the way, everything we say here is not investment advice, so please do your own research. We're not financial advisors, but we do invest and we do talk to people, individually, separately from this. But nothing. We're not recommending anything in here. But so this is a scoreboard. We rank. These are the chemical producers here. So Ganfeng, Albemarle, SQM. These are kind of big cap producing companies. Then you go down here, I have a list of spodumene producers. That's a precursor to making lithium chemicals. So that includes Western Australian spodumene producers, including Mineral Resources and Pilbara, as well as Galaxy.
So
then we have what I call...
So spodumene, that's the hard rock resources, and that's typically the way that lithium is mined. I'm just, for the viewers, they may not know what spodumene is.
That's a good point. So I'm going to go to the right here. So basically the scoreboard has a market cap. It has the share price. This is the 1 month performance. And this is from, right after Battery Day. You could see there's a lot of green here, right? Then there's the location, and then there's the type. Lithium Americas, they have a clay asset in Nevada, and they have an Argentine brine asset. Then where you asked about asymmetric, like where is that opportunity? In this kind of advanced development exploration, okay, these are companies that are much earlier stage. So at the bottom of the list here, there are some companies that are only 20 and 30 million market cap. 6 months ago, there were a lot here that were kind of 5 and 10 million market cap. And so if you go, this is where our focus is significantly. And if you look here, this is since Battery Day, near Battery Day. So some companies are up. There's Rocktech Lithium up 600%, right? E3 Metals is up, 400%, right? E3 Metals is a 74 million market cap now. That company, like I said, was 8 million market cap, 6 months prior to that. Piedmont is the top of the advanced exploration, right? They're now a 722 million. They're actually a bit more than that because this is a $49 price at the end of January. They're now about $60. But you get the point. Every month I put this out, and this is a starting point for me as to, which of the companies that I'm watching, how are they performing, which are, relative value and absolute value. So a company, like one of the companies we like a lot is this European Metals Holdings. It is a client of ours. And again, do your own research here, but it only has 140 million market cap. It's the largest, most advanced project in Europe, right? It's in the Czech Republic. It's a past producing tin mine. They're fully funded until their definitive feasibility study, and they're ready to kind of make a construction decision. And they have 100% of they're unpartnered today, right? So they haven't signed any offtake agreement, but that's likely to come sometime over the course of this year. So there's a very obvious and specific potential catalyst for European Metals Holdings to achieve something that Piedmont achieved, which is, an agreement with a Western automaker or battery maker, and that is an obvious catalyst that demonstrates, that a credential, and a brand to that, that company. In general, if we were to break down the world, again, we're focused on North American and European supply for North American and European demand. We used to like Argentine brines a lot, right, and Chilean brines, but in general, those brines make carbonate, right? Hard rock makes hydroxide more cheaply, or is the preferred route to make hydroxide. So the hydroxide that's going into the Cybertruck and the Semi, that's kind of where we want to be. So we spend a lot less attention than we used to on brines in South America, which we see, I see as carbonate focused, which is largely going to be sold into the China market, right? So it's going to be a lower priced product, and it's serving largely the it's the China market, it's the Asian market.
Yeah.
So
would that be used for lithium carbonate? My understanding that would be used for like lithium iron phosphate batteries, which are lower nickel.
Right.
Is that correct? Okay, cool.
That is correct. And lithium iron phosphate.
But to be clear, you can use anything up to a 622, an NMC 622. You can use carbonate. Once you get over 65% nickel, it's to do with the sintering process. You can't, and the temperatures, you have to use hydroxide above a 65% nickel. But anything, and you can use hydroxide you can use hydroxide in LFP if you want to. You can use hydroxide in anything. You just can't use carbonate above a 65% nickel cathode.
And if you follow Tesla, and I think the industry will follow Tesla, I mean, Tesla is getting into the hydroxide business from spodumene mines. What other spodumene mines are there in North America that might attract Tesla or Volkswagen or others to partner with? Well, Livent made one of the majors has recently made an investment in Nemaska in Quebec. So Quebec has a lot of spodumene, so does Ontario. So another company that we like, is Critical Elements here, which is in Quebec, which is similar to Nemaska. At the end of January, their market cap was about $150 million, but they're awaiting a permit, and they've been in discussions with a lot of different offtake partners for a long period of time, that have just been waiting for them to kind of get permitted. Another one is in Ontario, which is Frontier Lithium. It's listed here as 81 million market cap. Again, this is the end of January. These stocks have run a lot in February, so the market cap of Frontier, I think, is maybe twice that today. But still, even at a 100 million or 150 million market cap compared to Piedmont, at 800 million, there's a lot of gap from there. So Ontario, it's close to it's on the Great Lakes region, very high grade deposit. We like that story, very much. Been under the radar significantly. Is not, there's a lot of companies here that have a lot of promotion behind it, but not a lot of substance. Frontier has the opposite. There's a lot of substance, but the company has not been, very good at, getting its message out to a significant degree. So, I mean, those are names that we like on the hard rock side. So European Metals Holdings, for Europe, there's very limited resources in Europe, right? And European Metals Holdings has it's the biggest hard rock resource by far. I think bigger than all the others combined. It represents something like 50 or 60% of all of Europe's resources, and it's the most advanced, and it's right, it's within 500 kilometers of where all the battery and cathode plants are, in Central Europe. So we like that story. And then if I was to rank, where if by type, right? So hard rock is number one, in my opinion, again, because you can go direct into hydroxide. So it's cheaper, and it's more scalable, and it's in good jurisdictions. I would then rank as number two, from an asymmetric risk point of view. You were asking, we're very intrigued by these DLE, direct lithium extraction possibilities and technologies. They're not yet proven at scale anywhere, but the market is starting to understand that There are a number of technologies out there that have been proved on pilot, and demonstration scale that there's great hope that they will succeed. So the market is demonstrating enthusiasm for DLE brine and clay. We have a greater preference for the DLE brines, right? We want to see if clay could be proven by Ganfeng and Bacanora in Mexico, and we'll see if Lithium Americas could pull it off. So there are a number of other clay opportunities on here, like Cypress Development and Jindalee in Nevada and American Lithium. But in general, we're watching more closely companies like E3, which is a client of ours, again, in full disclosure. It's been a very good performer. We've had a number of investors come into that stock and they've done very well, but we think there's a lot more room to run because they not only have a technology, they also have their own resource, which is a very large resource and it's in Alberta. And if you think about Alberta as an oil province, this is an opportunity to kind of like make an energy transition in Alberta, from oil to lithium, simply by taking, waste, right? The lithium's in, depleted oil reservoirs, right? So it's a very, there's a lot of lithium in there. There's a lot of challenges. There's technology risk here. This is not a no-brainer. It still has a lot to prove over the next 3, 4, 5 years, but it has an enormous amount of upside. And if it works, that technology could be applied to other oil reservoirs in other areas in the world.
What we'll do is we could probably close this out for now and then have a conversation about some of the companies that you mentioned so people can get a feel for them. Because as part of it is people are interested in something that has a lot of room to run, but they're also interested in why that company is specifically interests you or why they might be interested in it. European Metals, that one, I'm relatively familiar with that one. That one's in the Czech Republic, and it's as you mentioned.
It's right on the border. So literally, it's a very large resource. It is on a historic tin mine that stopped in the early 90s when the price hit the skids. So you've got Ches, which is a state-owned utility, as its a joint venture partner. So you would think, if a 70% state-owned entity were to buy in, that one would assume your permitting is looking a little bit rosier than not. Otherwise, they should have done the due diligence going in to say yes. We're going to allow permitting. So last year, the entire battery market lithium demand was around 200,000 tons, maybe a little more. So Europe on its own, just for EVs, is going to be 1.6 times bigger than the entire global demand last year. So it's a big ask. You need projects. The other thing is, we think they're going to be quite generous government grants to assist in the building. You've seen subsidies for cell manufacturers, etc. We're expecting to see subsidies on the chemical conversion side, for projects like this, and some soft funding as well. So that improves the economics of the project. So that's EMH. It's going to produce a hydroxide. It's also a lower carbon footprint, just given what energy sources are available and the fact that it's a mica Zinnwaldite project. So it's not as hard as spodumene, as hard rock. So you don't have to heat it as high in the conversion process. So it has a lesser footprint.
Excellent. So it sounds like there's a lot of forcing functions and tailwinds there. You have the CO2 requirements to localize subsidies. Is just this whole, and demand, of course, because. And
I was about to say, and so what you're seeing is, because you've got the carbon passport coming in 2024 and actual enforceable limits that you've got to be below by 2027, it's a matter of time before the downstream customers look to sign up EMH, which is likely to be maybe not first, but very close to the first producer in Europe.
All right, yeah.
So
and
if
that
you look at what offtake contracts have done for the Piedmonts, the Core Lithiums, the other companies of this world, you know, it's a huge endorsement of the project to have someone sign offtake with you.
Yeah, and to be the first in Europe is something, it's a feather in their cap as well. And it sounds like that wouldn't be terribly difficult because it was an operating mine before. That's what it's designated as. Everything's in place. It's just...
And the other thing not to overlook, Jordan, is, you know, the spodumene concentrate producers had contracts with Chinese companies, but Chinese companies can renege on those contracts and there's no legal recourse. No one did anything because they're the only customers and everyone just accepted it. If you sign offtake agreements in Europe with European companies, then you've got a bankable credit that you can take to funders, assuming it's a quality company, you know, that's committing, you know, pick a name, but even the cathode manufacturers, a lot of these businesses, you know, BASF, Umicore, they're all coming in as well. You look at the battery cell plants, these are good credits to, you know, to have as your offtake partner.
Yeah, trust is always, it's an unappreciated factor in business and getting things done. Operating in a market that's trustworthy and having partners that the market trusts is huge. We
agree.
All right. So I feel like that covers off European metals really well. Now, Frontier, where is that located, and what's some of the stories?
Frontier's in Ontario, and in my opinion, in terms of just the deposit itself and the quality of the ore body, its grade, its impurities, and the width of the dikes, it's in the top 3 in the world. So they are progressing. They've just released a PEA, a preliminary economic assessment, to look at being a hydroxide producer by 2025. But as it happens, such is the quality of their ore that they have an opportunity to make what we call a technical grade spodumene. So you make a chemical grade spodumene to go into the chemical plants for batteries, but you can make a technical grade spodumene which has an iron content of below 0.15, and that can go to the glass and ceramics market. That price it trades at substantially, it's, you know, 2 to 3 times what chemical grade spodumene trades at. So they've got in their pack deposit, I mean, they have lithium grades at surface of as high as 4%. So, you know, versus what a lot of projects only have 1. And with this low iron content, they have an opportunity to do a pilot plant and make a technical grade spodumene to sell into that glass and ceramics market, and produce a chemical grade spodumene to continue their test work on making hydroxide. As it happens, they've partnered with XPS, which is a Glencore company. They've got a mini pilot plant going on making hydroxide. So as a broad rule of thumb, and Howard always says this, if you can make 20 to 25,000 tons of hydroxide, if your capex is going to be 650 million, and you can keep your operating costs at $5,000 a ton or less, that's kind of a blueprint for a $1 billion NPV. And that's exactly kind of the PEA of Frontier came out at 975 million, the NPV. Now they're behind some of the other companies in terms of feasibility studies. They're at a PEA level. A lot of the other guys are already at PFS or doing a DFS, definitive, so you go to your final bankable. So they're probably 18 to 24 months behind, but they are trading at, you know, 0.15 price to NPV of 0.15. Granted, it's an unfunded ratio, but from an ore body perspective, it really is, you know, they've got up to 40-meter widths, which you don't really get. You know, when you mine thinner, dikes, you can lose a bit of mining dilution because you're taking narrow strips out, but 40 meters, you know, you might lose slightly on the fringes, but you're really going to have a good recovery. And as I say, they got a low iron content. I think the mic is also, very much manageable. So in terms of the quality of the ore body, a consistent and homogeneous product, if you can produce a consistent and homogeneous spodumene concentrate, the probabilities of producing a battery-grade hydroxide off a consistent and stable and very clean spodumene is higher. And we think that Frontier delivers that.
Oh, that's really persuasive. So it's the ore grade, it's high percentage, and then on top of that, the beds that the ore that are sitting in are extremely wide. So, like for instance, if you have a tool and you're trying to chisel out an area of rock that's very narrow, there's not much margin for error. But if you have an ore body that's meters and meters wide, you can just drive a dump truck through it and scoop it out, and you don't have to worry so much about getting contaminants.
And they mostly have it at surface.
Oh, wow.
So you're pretty much mining into the ore body. So if you go and look at their website, you can see the lithium, white at surface at the PAC deposit. It's based in what they call Electric Avenue in Ontario. So the names of the deposits are PAC, Spark, Bolt. They have those kind of names on them. And you can have a look at it. And the CEO who runs it comes from a mining family. They have moved a lot of dirt in their time, and they are, my understanding is they are the only company that has a manufacturing explosive license in Canada. So they have a long history of actually mining material, but they are slow and steady. They're not rushing it. So we feel that that's fine, because we feel that the lithium market, given where EVs are going and demand for batteries in general, and if you look at energy storage, that really is something that's going to come into play, I think, later on this decade, is if you've got a constructive lithium market, then you don't have to be in a mad panic to rush your feasibility and get to where you're going, because prices are going to be supportive going forward now, because the floodgates have opened on EVs. I mean, if you think about it, you've got Tesla, which is a pure EV company, saying cells are our constraint, and we're at a 4.6 EV penetration globally. We're on our way to 100, preferably, and we're talking about cell constraint at 4.6%. So, I know it's cells themselves, but raw materials are obviously aligned into that. So what we're saying is, if you can find companies that fit the profile that Howard always likes, of size of production and capex and operating cost and price, then they should all end up in the same place, which is around a $1 billion NPV. It's a question of what you pay for it and how long you've got to wait for them to put it into production.
Now, one or two more questions on Frontier is, now, does that technical grade lithium that they produce, does it cost extra to produce that, or is that just a side effect of the type of ore?
That's a good one. So I know at Greenbushes they have to fine grind it to get rid of the iron content, because if you put like a hot plate or whatever it is on a glass that's got too much iron content, it can crack, or there are things that can happen. So getting the iron content down. But what you find is in a lot of spodumene deposits, there's iron in the lattice of the spodumene, so you can't get it out. So it's not suitable to making a technical grade. My understanding with Frontier is that they don't have to overly fine grind it. So if you look at the fees at the PEA, I think they're talking about, and now I could be wrong and might have to backtrack, but I think $335 a ton ex-works is the price of the spodumene, and I think that spodumene is both chemical and technical grade.
All right, interesting. And why?
I need to double check that.
Okay, well, if that's the case, I can always splash something up to correct it, or we can remove that.
Sorry, the one thing I can say is that when they looked at doing a at doing a technical grade product, the IRR on that project was 38%.
All right. So
very high returns.
So how long would that take? Was to be about
2.5 years payback.
Yeah,
roughly.
2.5 years payback. Nice.
Very nice. But as I say, they've got 4% at surface, but hydroxide for EVs is the grand prize here.
Yeah, but it's nice to know they have those fallbacks in other areas with the technical grade and glass.
The thing is, they can participate in that market and earn a very good margin without disrupting their progress to producing hydroxide for EVs. In fact, you have to do a demonstration or pilot plant one way or the other to prove this up. So the fact that you can actually make a technical grade and sell it into the glass market at a profit, at a handsome profit, whilst you continue your feasibility on the hydroxide is a nice add-on.
All right. And while we're on the topic of PFS and DFS, that's a pre-feasibility study and definitive feasibility study?
So essentially what happens is with a pre-feas, I think you're allowed to be within 25%? I think it depends which country, but let's call it 25% of the final number. You need it within accuracy. And when you do a definitive feasibility, it's typically 15%, within 15% accuracy.
All right. So the pre-feasibility study, that's usually, I don't know, you're going to have to correct me because I'm not that familiar with these, but it's like pre-feasibility study would be like 3 to 4 years away from production, whereas definitive feasibility study is 1 to 2 years. How? Yeah,
that's not a bad call. Well, you can do a pre-feas and then you can do a pre-feas and do a definitive feasibility depending on what you test and what you tick off. So the other thing that comes into play in order to be more accurate is you have to have more of your resource and measured and indicated rather than inferred. So the spacing of the drilling needs to be narrowed, so you've got to be sure about what you've got. But you can do a definitive feasibility study within a year of finishing a pre-feas.
E3 Metals is one that I've had several of my patrons ask about. It's one that they're very interested in. It's because it's direct lithium extraction, and that's really captured people's minds at the moment, be able to extract lithium directly from a brine and turn it into a finished product. So it's not something I know much about. Probably a good place to start with E3 is, again, where is it located and why is it a persuasive story for you?
E3 is located in Alberta. It's the project's at the Leduc Reservoir. So it's a contained aquifer. So it's not like, other brines that you have in South America that are almost, a living organism of flows of water flowing in and out or brine flowing in and out. This is contained. It was an old oil, a petro, area. So what they had is very fortunate for E3 is that it had a lot of historic drilling or testing. So they had all those results. They didn't have to do it again. They didn't have to reinvent the wheel. They knew what they had there. The trick, again, is E3 has an enormous amount of contained lithium within the Leduc Reservoir that they own. But the issue that they have had to overcome and the challenge they overcome is it's not a very high grade brine. It's a lower grade. You're talking sort of 70 to maybe 100 ppm. So what they did is they partnered up with the University, I think, of Alberta, and they've created what they call a sorbent, the beads, the resin, in order to attract the lithium ions, and then you wash it off once. So you need a very resilient resin in order to be able to flow a lot of brine through to a low grade brine through to attract it. So they partnered with Livent. Livent has moved on. They're doing it on their own. They're busy building a pilot plant. They've had a lot of support and government grants, so you haven't seen masses of share issues and dilution to get where they are because they've had the historic drill holes, they've had government grants, and they've partnered and they had the support. For E3, they both own the resource and they own the technology. So that's dissimilar to some other competing products. In their instance, They control both. And again, it's, the one thing, that we do like is, for sure, is it's a scale out, not scale up project. So once you've got a working pilot plant of a decent size scale, you're just modularizing it, and you have, I don't know if you've ever seen sun resins deposit in China, maybe you can put the picture up, there's a whole lot of these cylinders. So once you've got one of those chambers, you're just putting a lot of chambers in place. So there isn't a risk of going, like other lithium deposits where you pilot at a certain level and then you build a much bigger plant. This is, if you get it right, yes, there's some possibly, moderate engineering challenges, but then you just simply are putting a modularized, amount of production in place. So they have the potential to scale up substantially once they get going. I think their PEA, also, Howard, correct me, but I think the pre-tax NPV was around about $1 billion and the after-tax about 800.
Yeah, I think that's right.
But that's for 20,000 tons, but they have the potential to scale the production up there to over 100,000 tons. There's lithium. I think they've also got like 7 million tons. You can really, you've got lots to draw from. The trick is if they can extract the lithium with a resilient resin and get a decent recovery. And they've done it at lab scale. They're moving on to pilot plant. If they can do it, then you've got a very good chance of producing a very high quality, low impurity lithium hydroxide. And that's the grand prize here, is if you can do that, given the scale of the resource and what they could do with production, the asymmetric you talk about, is unlimited here.
It's asymmetric because they own the technology, they own a large resource, the technology can be licensed elsewhere, and it's not disruptive in our estimation. It's not disruptive in terms of lowering the CapEx or lowering the OpEx of producing lithium in a meaningful way. So it's not like, oh my God, everyone is just going to do this and they're not going to do hard rock because this is so much better. But it will, compared to brines in South America, which have very large land footprints, which, the recoveries are much lower, even though they're higher grade in the ground, they come with all sorts of issues, geopolitical and other issues that we talked about, that if this works, then there are lots of oil reservoirs in other locations that this could then be applied to. And we think that Alberta is an ideal location for this, to make up for the low concentration. So it's like 80 parts per million, right? That compares to, let's say an Argentine brine that might have 400, 500, or 600, ppm. So it's meaningfully lower ppm. However, brine flow rates are very important in processing brine. So in Argentina and Chile, you can't flow the brine super duper fast, but in Alberta, a lot of the success, apart from the resin, a lot of the success is how fast you can pump the water through these cylinders. And in Alberta, in oil industry, they know how to move water, right? There's skills there to do that. So if you can move the water very fast and the resin holds it, is very selective for lithium, then you can concentrate it, in a fast way, and then you're making it a high purity. That's a part of the secret sauce there. So this has gotten a lot of political support. The premier of the province, I think Kenny, I've seen him tweet, about this project, right? And you mentioned the Alberta, academia and the like. There's a lot of support for this. This is a major, like Alberta's an oil province, right? So to the extent that the world is, anti-oil, it's not like, people in Alberta have made their livelihoods there. It's they're looking for, different things. So this is definitely has political support. They've gotten some grants and the like, but from a permitting perspective, this should be no problem at all. And it's a North American jurisdiction. If you look, you talk about Piedmont or Quebec or Ontario proximity to Austin, Alberta down to, Nevada down to Texas also is very similar. So
the other, as I mentioned, Jordan, because it's a contained aquifer, and from what I recollect, from my recollection in terms of the drill results, is you are dealing with a very consistent body of brine. So when you say, as much as the ppm is low, you're able to calibrate and set, how you design the resin, etc., for what's very consistent in terms of what's coming through in lithium and other minerals within that brine. So when you have a normal, when you have a conventional brine, they've got to be very careful where they pump from and keeping the potassium levels and so on and everything consistent, because it's different in different parts of the cellar. As I say, it's like almost a live organism that things are moving around and happening. And if you get your pump and your flow rates wrong, suddenly you are struggling with what it is that you're trying to process through the plant. So yes, it has a lower grade, but I think given that it has a very consistent nature across it, if you can crack that code, then you're off to the races, because you've got a massive body of brine that you can then process.
This is generating so many questions for me. It's fascinating to learn about because it's.
Well, we're going to put you on Chris Dornbus because he understands. It's a selective absorbent technology. That's the ion exchange.
Mm-hmm.
So and he can sort of explain it, but the recoveries of lithium, in their test work have been high, and then what they do is they re-inject the brine 12 kilometers away. So quite a lot of the CapEx and so on was pumping it back much further away, because you obviously don't want to pump back, a stripped brine back into too close to where you're going to pump out. So that comes with a cost that they've done. As Howard said, the CapEx is similar, but the world needs consistent and high quality lithium chemicals. It needs hydroxide, but obviously carbonate as well. And this is a way of doing, this is a potential way of doing it with massive opportunity, because the Ladruc Reservoir, the land package they have is huge.
All right. And I'll try to wrap it up with E3, even though I have a list of questions here. How far along are they with PFS or DFS?
So they're PEA, so they've just finished their PEA. Now they've got to go onto PFS.
Okay. And
they're also setting up a pilot plant in Alberta, Howard, that's correct?
Yes.
All right.
So they'll be doing they're going above lab scale to now pilot plant, to making sure that you're pumping it bigger volumes through to test. So they've already made hydroxide off the lab scale. Now you need to move to pilot plant and do it again. And then you're moving closer to, as I say, these cylinders. Have a look at Sunres and you'll see they've got a range of them that they all have there. So once you get to a certain size, then you're done. Then you're just modularizing it. You just scale out, not up.
That's excellent. I'll just try to summarize for people here. So it's using direct lithium extraction is becoming a pragmatic reality. The technology has reached the point now where it's ready for production scale, and it looks like we're going to be seeing it in the next few years. And I do think it's a good idea for me to sit down with the CEO or the chief technical officer of E3 and get a better feel for what's going on there, because I have a lot of questions about it. So overall, I appreciate your guys' time today. We did.
Thanks a lot, Jordan.
We did quite a deep dive into a number of different topic areas, and that's not easy. And it's impressive the amount of knowledge you've accumulated about these companies. It was really interesting. Thank you.
Thanks very much for having us, Jordan, and really appreciate it.
Cheers. If you enjoyed this video, please consider supporting me on Patreon with the link at the end of the video, or snag something off the merch shelf below. I'm also active on Twitter and Reddit. You can find the details of those in the description, and I look forward to hearing from you.